Welcome to the Deep Dive. Today we're going to be looking at finance and investment.
Okay.
We've got a really cool mix of sources here, some academic stuff, guides for entrepreneurs, even some advice on pitching business ideas.
Wow, sounds pretty diverse.
Yeah, and our goal today is to really help you grasp these concepts so you can, make better financial decisions.
I think that's something everyone could benefit from, like whether you're running a company or just trying to manage your own personal finances, these principles pop up everywhere.
Absolutely. So to kick things off, I was looking at this PDF, Analista de Investimentos material-terico.pdf, I think it was. Um, and it really emphasizes maximizing shareholder value as the core objective of corporate finance.
Right, yeah, it's all about making sure those who own a piece of the company, those shareholders, see their investment grow. That's the main thing that financial managers are trying to achieve. They're making decisions that will ultimately increase the value of the company for those shareholders.
So what kind of decisions, specifically, are we talking about? What are these financial managers doing all day?
Well, they've got a lot on their plate. They're figuring out where to invest the company's money. Should we, build a new factory? Should we invest in research and development? And then they've got to decide how to finance those investments. Do we take out loans, issue stock, or use retained earnings?
Oh, right, right. And I guess they also have to decide how much profit to pay out to shareholders as dividends versus reinvesting back into the business, right?
Exactly. It's like a constant balancing act.
Now, this PDF also mentions a kind of a tricky point. It talks about potential conflicts between managers and shareholders. Like sometimes executives might be more focused on their own compensation and perks rather than truly maximizing returns for investors.
Yeah, that's a classic principal agent problem. When the incentives of the people making decisions, the managers aren't aligned with the interests of those who own the company. The shareholders, it can lead to, well, let's just say it can create some tension.
Totally, totally. Makes sense. Now, another thing that I found really interesting was the whole concept of risk and return.
Oh, yeah, that's a fundamental one.
I saw this really cool chart in the same PDF. It was data from Ibbotson and Sinquefield, and it showed historical returns for different asset classes, like stocks, bonds, T-bills. And it was just amazing to see how much a dollar invested in small-cap stocks back in 1925 would have grown compared to other investments.
Yeah, that's the classic illustration of the risk-return trade-off. The higher the potential return, the greater the risk you have to be willing to stomach. But that data also shows the power of time and a long-term perspective. If you can ride out the inevitable ups and downs of the market, you can see some pretty significant returns, even with assets that might seem risky in the short term.
But how do you actually measure that risk? Is it just a feeling, or is there a more, concrete way to assess it?
Well, there's this concept called the risk premium. Basically, it's the additional return that investors expect to receive for taking on more risk. Like, you wouldn't expect the same return from investing in a risky startup as you would from a well-established, blue chip company.
Right, right. Makes sense. But then how can I, as an investor, try to manage that risk? I mean, is it all just hoping for the best?
Well, one of the best strategies for managing risk is diversification. Don't put all your eggs in one basket. Instead, you spread your investments across different asset classes, different industries, even different countries. That way, if one investment goes south, it doesn't wipe out your entire portfolio.
Right. It's all about balance, I guess. And speaking of balance, I noticed that a lot of our sources talk about this thing called the cost of capital. What exactly is that, and why should I care?
Good question. It basically refers to the return a company needs to earn on its investments to satisfy its investors. Each source of funding, whether it's debt or equity, comes at a cost. So the company needs to earn more than that cost to actually be profitable and create value for its investors.
So is one type of financing always better than the other? Is debt always cheaper? Or is equity the way to go?
It's not that simple. There are definitely trade-offs to consider. For example, debt financing, like taking out a loan, is often cheaper than equity financing because the interest payments are tax deductible. But the catch is, if you take on too much debt, it can increase the risk of financial distress for the company, especially if their earnings take a hit.
Oh, so it's a bit of a balancing act. You want the benefits of cheaper financing, but you don't want to be so burdened with debt that it could cripple the company.
Exactly. And that leads us to another important concept: capital structure.
Oh, yeah, I remember seeing that term.
It essentially refers to the mix of debt and equity that a company uses to finance its operations. It's a strategic decision that can really impact a company's financial health and its ability to grow. Now, there's a famous theory in finance called the Modigliani-Miller theory, and it suggests that in a perfect world, one without taxes or bankruptcy costs, the capital structure wouldn't actually matter.
Really? But that doesn't sound very realistic, does it?
Right.
I mean, the world is full of taxes and all sorts of other complications.
You're right. In the real world, things are much messier. Taxes, bankruptcy costs, those things definitely impact the optimal capital structure. Think about it this way. Taking on some debt can be advantageous, especially with the tax benefits. But having too much debt can make a company really vulnerable, especially if there's an economic downturn or unexpected event. So it's all about finding the sweet spot.
Right, that makes sense. So companies need to find that balance where they can use debt strategically without putting themselves at too much risk. Now, all of this talk about finance and companies and investors leads to another big question: valuation. How do we figure out what a company is actually worth?
Yeah, that's the million-dollar question, isn't it?
I came across a bunch of different valuation techniques in value.pdf, things like discounted cash flow analysis, comparables, and even the first Chicago method. It all seemed a bit, well, complicated.
Yeah, it can get pretty complex, but understanding the basics is important. The main thing is valuation is all about figuring out what a company or an asset is worth. And there are various ways to do that.
So let's start with discounted cash flow, or DCF analysis. I've heard that term thrown around a lot. What's the gist of it?
The basic idea is that a dollar today is worth more than a dollar in the future, because you can invest that dollar today and earn a return on it. So DCF analysis tries to capture this by looking at a company's future cash flows and then discounting those cash flows back to their present value.
So it's like predicting how much money a company will make in the coming years and then figuring out what that future stream of earnings is worth right now.
You got it. And value.pdf actually walks through a really helpful example using a fictional widget factory. They show how you can estimate future cash flows, determine a terminal value, and then discount everything back to the present. It's a good way to visualize the process.
That sounds super helpful.
Yeah.
But what about startups? They don't have a long history of earnings to analyze, right? So how do you value them?
Yeah, that's where things get a little trickier. For early stage companies, especially ones with limited financial history, you might need to use other valuation methods.
Okay, like what are some alternatives to DCF?
Well, there are comparables, for example.
Comparables. I remember seeing that. Is that like comparing apples to apples?
In a way, yes. With public comparables, you look at publicly traded companies that are similar to the company you're trying to value, and you see how the market values them. You look at things like their price to earnings ratios, their enterprise value to revenue multiples. It gives you a benchmark.
So if a similar company is trading at a certain multiple of its earnings, you could potentially apply that same multiple to the startup you're evaluating to get an estimated valuation.
Precisely. Transaction comparables take a similar approach, but instead of looking at current market prices, they look at past acquisitions of similar businesses, so you can see what buyers were actually willing to pay for those companies.
Oh, that makes sense. And I also saw something called the first Chicago method. What's that all about?
Yes, the first Chicago method. That's a specific variation of DCF that's really useful for dealing with situations where the future is very uncertain. So instead of relying on a single set of projections, you create multiple scenarios, like a best case, a base case, and a worst case scenario, and you assign probabilities to each one.
So instead of assuming one outcome, you're acknowledging that there are multiple possibilities and trying to weigh those possibilities accordingly.
Exactly. This approach can give you a range of potential valuations and helps you understand, the potential upside and downside risks.
Wow. So there's a lot to consider when it comes to valuation. It's definitely more nuanced than I initially thought. But this has been a great overview so far. We've covered the basics of corporate finance, the importance of risk and return, and we've even dipped our toes into valuation. I'm really starting to see how all these concepts are interconnected.
It's fascinating, isn't it? How it all fits together.
It is. It is. But I'm curious, how does all this corporate finance stuff relate to me? Someone who's not, running a company. What's the practical application of this knowledge?
That's a great question. And that's something we'll dive into in the next part of our deep dive, because believe it or not, many of these concepts translate directly to your personal financial decisions, whether you're planning for retirement, managing debt, or even just trying to, understand the value of your own home.
Okay, now I'm really intrigued. I can't wait to see how we connect those dots.
Well, you'll have to stay tuned.
Welcome back to our deep dive into the world of finance and investment. In the last part, we talked about all those valuation techniques like DCF analysis and all that. But how does that actually apply to me as an individual? I don't have, like, analysts and fancy spreadsheets at my disposal.
You don't need a whole Wall Street team to benefit from those concepts. Think about something like buying a house, probably one of the biggest financial decisions you'll make.
Yeah, for sure. Home ownership is definitely on my radar.
Well, think of your mortgage like a DCF analysis in action. You're essentially evaluating those future payments, your monthly mortgage installments, and figuring out what you're willing to pay right now, today, for that whole stream of payments.
So understanding how interest rates impact those future payments and being able to calculate, the total cost over the life of the loan, that could actually help me negotiate a better deal or even just decide if buying a house is the right move in the first place.
Absolutely. It gives you the power to make informed choices. And those comparables we talked about, those are relevant in real estate too. Checking out recent sales of similar properties in your area can give you a sense of whether the asking price is reasonable.
I never realized how these concepts, like, actually play out in my own life.
They're everywhere. Once you start to recognize them, it's kind of like, oh, there it is again. And speaking of things that hit close to home, let's talk about debt. We mentioned that it can be a useful tool for companies, but it can also be a double-edged sword for individuals.
Oh, tell me about it. Student loans, credit cards, it can feel pretty overwhelming sometimes.
It's super important to understand how interest rates work and the different types of debt, like that high-interest credit card debt can spiral out of control if you're only making the minimum payments.
Oh, yeah. That minimum payment always seemed so manageable at the time, but I never thought about what it meant in the long run.
Right, it might seem okay now, but it means you end up paying way more in interest over time. Understanding things like amortization, which is that process of gradually paying down the debt over time with those regular payments, that can help you make smarter choices about how you tackle your debt.
So if I focus on paying down my high-interest debt first, like aggressively, I can save myself money in the long run. It's like a light bulb moment for me.
Exactly. It's all about understanding the trade-offs. Now, shifting gears to investments. Remember that chart from Ibbotson and Sinquefield we talked about? The one showing the impressive growth of small cap stocks over time?
Oh, yeah, the one that made me want to invest everything in the stock market. Hard to forget that one.
Well, it really highlights how important it is to choose investments that align with your risk tolerance and your time horizon.
Can you explain what you mean by that?
Sure, if you're young and you're saving for retirement, you've got decades ahead of you. So you might be comfortable taking on more risk because you have more time to recover from any potential losses. That means you might put more of your money in stocks because historically they've had higher returns than bonds.
But what about someone who's closer to retirement?
Well, as you get closer to retirement, your time horizon shrinks. You probably want to shift towards a more conservative approach. Maybe put more money into bonds or other less risky assets to protect your savings. It's all about adjusting your strategy as your life changes.
Makes sense. It's not a one-size-fits-all thing.
Not at all. And don't forget about diversification, that idea of not putting all your eggs in one basket. It's even more crucial for personal investing. You don't want your entire financial future hinging on the performance of just one stock or one type of investment.
Right. It's about building a portfolio that's diversified and tailored to my specific goals and risk tolerance.
That's the key. And don't underestimate the emotional side of investing. Fear and greed can really mess with your decisions. But if you understand these basic financial concepts, it can help you stay level-headed and make more rational choices, even when the market gets crazy.
This has been so eye-opening. It's like I'm seeing my own personal finances through a whole new lens.
I'm glad to hear that. That's what we're aiming for, to empower you with knowledge so you can take control of your financial well-being.
This has been an amazing journey. But we talked about how companies raise capital through debt and equity. How does that relate to personal finance? Do I have, equity as an individual?
That's a brilliant question and a perfect transition to the next part of our deep dive because, believe it or not, you do have something akin to equity. And understanding this can really change how you view your personal finances.
Okay, now you've really got me hooked. Tell me more about this personal equity thing.
Welcome back to the deep dive. We've covered so much ground, from corporate finance to personal applications, and last time you left me hanging with that idea of personal equity. Right.
What exactly did you mean by that?
It's kind of a way of thinking about your personal finances that can be really powerful. Imagine yourself as a company. You, Inc.
Okay.
Your skills, knowledge, your earning potential. All of those represent your assets.
Interesting. So how does this you, Inc. idea. How does that change how I view like my day-to-day finances?
Well, think of it this way. A regular company, invests in its assets to generate profits in the future.
Right.
So you should be investing in yourself to increase your future earning potential.
Okay. Yeah, I get that.
That might mean, going back to school, learning new skills, networking, even just taking care of your health.
So I'm like both the investor and the asset at the same time.
Exactly. And just like a company might issue equity to raise capital, you can leverage your personal equity to kind of like secure your financial future.
How so?
Well, think about it. When you're young, your earning potential is really high, but you might not be earning a lot right now.
Tell me about it.
But you're essentially, you're borrowing against your future earnings.
By investing in myself.
By investing in yourself, right. You're taking on, maybe some debt, maybe it's opportunity cost to acquire those assets that will pay off later.
So my student loans, for example, that's like me investing in my future earning power.
You could definitely see it that way. It's like taking on debt to buy an asset that you believe will have a return in the form of higher earnings.
But just like with company debt, I need to be careful, right?
Absolutely. You have to manage that debt very carefully.
Make sure that the return justifies the cost.
Exactly. That's why you need to be strategic about these investments in yourself.
Okay.
Choose education and skills that are in demand, negotiate for fair compensation, always be looking for ways to increase your value in the marketplace.
It's like building my own personal brand, I guess.
Yeah, that's a great way to think about it. And just like a company's brand value can go up and down, your personal equity will also fluctuate based on, your skills, experience, network, even just your reputation.
So this ongoing thing.
It is, yeah. It's all about maintaining and growing your value over time. And, this actually brings us to another important aspect of personal finance.
Okay, what's that?
Risk management.
We talked about diversifying our investments before, but how does that apply to you, Inc.?
Well, think about your career, for example. If you rely on only one employer or one specific skill set, that can be pretty risky.
Oh, yeah, for sure.
If that company downsizes or that skill becomes obsolete, then your income could take a big hit.
So I need to diversify my skills, have a backup plan.
Exactly. Build a strong professional network. Maybe have a side hustle, have options.
It's all about creating a safety net.
Exactly. It's about mitigating those risks that could really impact your financial future.
I love this framework. It's like a whole new perspective.
That's what we're going for, new perspectives and tools to navigate this whole world of finance.
This has been, seriously, one of the most insightful deep dives yet. We've learned so much from like the inner workings of companies to this whole personal equity concept. I feel like I actually get it now, like how finance is woven into all parts of our lives.
It's pretty amazing how it all connects, isn't it?
It is. It is. Thank you so much for walking me through all of this. I feel like I'm equipped to make better decisions and build a better financial future for myself.
That's awesome to hear.
And a huge thanks to our listeners for, sharing your sources and letting us explore them. I hope you've enjoyed this journey as much as we have and that you feel empowered to take control of your own finances. That's it for this deep dive, but keep learning, keep exploring, and we'll see you next time.